All right, let's dive right into today's explainer. We're going to unpack a seriously fascinating data dossier that connects the highly visible airspace of modern warfare with the deeply submerged realities of financial order books. Now, you might be wondering, why does this matter to us? Well, the intersection of military might and global finance literally dictates where billions of your tax dollars go and how massive market secrets move the global assets you might actually be invested in. On the surface, the data tells a story of overwhelming military dominance. But as you'll see when we look just beneath the waterline, we uncover a stark paradox and a multi-billion-dollar mystery hiding right in plain sight.
Here is our quick roadmap for today. 1. The F-35 dominance. 2. The aging fleet paradox. 3. The $580 million short. 4. A system of anomalies. 5. The crypto evasion rail. And finally 6. The sound of silence.
Let's start with Section 1, the F-35 dominance, which is the highly visible surface of our military capability.
So when we look at F-35 growth, the numbers are just staggering. With over 1,330 deliveries, 1 million flight hours, and 20 different nations operating the aircraft, the F-35 Lightning II program projects this image of overwhelming ultra-modern dominance. The source data confirms over 3,390 pilots have been trained, and the program boasts hugely successful operations like Epic Fury and Absolute Resolve. If you look purely at this massive F-35 growth, you're seeing a technological marvel operating from a position of absolute comfortable surplus.
But let's move to Section 2, the aging fleet paradox. This is what actually lies beneath that shiny narrative.
While F-35 growth dominates the daily headlines, the hidden reality is that the broader U.S. fleet heavily relies on retirement-era Cold War airframes to carry out its actual operations. According to the source analysis, aircraft that were shot down or destroyed in recent conflicts included an F-15E Strike Eagle, a plane designed in the 1970s, and an A-10 Warthog averaging between 43 to 50 years old. Get this, the A-10 that was lost was an aircraft the Air Force had been legally mandated to retire, but they had to extend its service to 2030 because of ongoing conflicts. So, you have a situation where a supposedly next-generation military is out there actively relying on hardware from the Reagan era. It's a massive disconnect.
And it actually gets worse. In April 2026, 22 National Guard adjutants general formally warned Congress that the Air Force is facing an unprecedented readiness crisis. They stated, on the record, that the Air Force is the oldest, smallest, and least ready in its 78-year history. They were urgently asking for 72 to 100 new fighters per year just to maintain a baseline of readiness. This is the reality of a military apparatus funded by billions in taxpayer dollars, claiming structural dominance, yet fundamentally strained right beneath the surface.
Okay, let's pivot to Section 3, the $580 million short. We are now descending into the deepest market secrets. Before we dissect the order book, it's absolutely crucial we're on the same page about what a short position is. Basically, it allows someone to make millions if they know a price is about to crash. In the futures market, you aren't actually taking delivery of barrels of oil. Instead, you're placing a highly leveraged bet on its future price. If you short oil and the price plummets, you make an absolute fortune. And because of how margin requirements work, you can control hundreds of millions of dollars in exposure with just a fraction of that amount in upfront cash.
So picture this. It's the morning of March 23rd. The U.S. president had just issued a 48-hour ultimatum over the weekend regarding the Strait of Hormuz. By Monday morning at 6:49 a.m., there are threats to bomb Iranian power plants, and oil is trading around $100 a barrel and climbing fast. Every public signal, every geopolitical indicator is unanimously bullish. Prices are going higher. Yet, amidst all this, someone inexplicably sold 6,200 oil futures contracts in literally 60 seconds. Basic trading analysis tells us that dumping 6,200 contracts on a thin, pre-market book in 60 seconds guarantees massive slippage. That means whoever did this knowingly paid a very heavy premium for speed. They acted like they had a hard deadline.
And here is exactly why they were in such a rush. Just 15 minutes later, at 7:04 a.m., a post drops on Truth Social announcing very good and productive conversations with Iran. Boom, a major diplomatic de-escalation. Instantly, oil prices drop by more than 10%. That $580 million short position placed just minutes prior suddenly netted the unknown seller up to $100 million in profit. According to the trading analysis from our sources, executing a trade of this massive size directly against the prevailing market sentiment exactly 15 minutes before a market-reversing announcement, that goes way beyond a lucky coincidence. It's a glaring statistical anomaly pointing straight to informed order flow.
Which brings us to Section 4, a system of anomalies.
Because one weird trade is an anomaly, but what happens when it becomes a structural pattern?
You see, the order book doesn't lie. When we plot these dates, we see this highly suspicious pattern repeated 3 times right before non-public diplomatic announcements totaling $2.29 billion in exposure. On April 7th, a $950 million short was positioned just hours before a 2-week ceasefire was announced, making oil fall 15%. Then again, on April 17th, a $760 million short was placed exactly 20 minutes before an announcement that the Strait of Hormuz would remain open. In all 3 of these cases, the short was placed directly against the bullish market sentiment that had been deliberately whipped up by escalatory public rhetoric in the days prior.
So the takeaway here is that this was not some lucky retail trader trading from their couch. This is a pre-established institutional system operating with incredibly high conviction and deliberate anonymity. You don't just execute 6,200 contracts in 60 seconds on a whim. You need direct market access, high-speed algorithms, and tens of millions of dollars sitting ready in a pre-approved margin account. Plus, these trades were placed on CME Globex and IC Futures Europe. The source notes these are what practitioners call no-name give-up markets, meaning the central clearinghouse completely hides the buyer and seller from each other. Honestly, who possesses this kind of institutional infrastructure while requiring total anonymity? These are the deepest kinds of market secrets.
Let's look at another angle in Section 5, the crypto evasion rail. We're tracking the financial shadows here.
While the futures market was dealing with these massive shorts, there was a whole other hidden financial battlefield operating over in the cryptocurrency space. Forensic analysis identified the Tron blockchain, known as TRX, as a central conduit used by Iranian networks to systematically evade sanctions during peak wartime activity. Financial intelligence reports show that major centralized exchanges were actively used to route billions of dollars via Tron to just bypass global financial restrictions altogether. It essentially became the hidden rail for moving capital when traditional avenues were locked down.
And check out this stark divergence in the data. TRX surged nearly 12% precisely during the 90-day window that covers those oil anomalies, completely breaking away from major assets like Bitcoin, while Bitcoin and Binance Coin were actually down significantly over that exact same 90-day period spanning March and April. Tron spiked. The source calls this a change point divergence signal. That's a fancy mathematical way of saying that Tron's market behavior was fundamentally altered by the massive hidden utility it provided during the exact same time frame that those billions of dollars in oil shorts were being executed.
Finally, we reach Section 6, the sound of silence, the total absence of an institutional response.
You know, in market structure analysis, sometimes the absolute loudest signal is when there's no reaction at all. The data records a complete absence of institutional response from top officials. After that March 23rd trade, the anomaly was front-page news globally, and yet, total silence from the president and from Treasury Secretary Scott Bessent. Keep in mind, Bessent is a former macro hedge fund manager. He intimately understands what a $580 million short on a thin book implies. Furthermore, the source documents that the CFTC Enforcement Division lost 24% of its lawyers since 2025. That gutting left the Chicago office, which is the specific office responsible for investigating oil trades, with literally 0 staff. The deepest market secrets aren't just the trades themselves. It's the permissive environment that allows someone to execute at increasing scale in full public view with complete confidence they won't face any regulatory pushback.
So, when the architecture of market integrity is met with deafening silence, we have to ask ourselves, what do the shadows hide when nobody is looking? The source material leaves us with a pretty chilling realization. Between the aging jets masked by narratives of F-35 growth and billion-dollar trades perfectly timing non-public diplomatic announcements, the data tells a story of an environment where massive informational advantages are being systematically monetized. For the everyday citizen and investor, this raises profound concerns about the fairness of the markets where your pensions and savings reside. If the order books don't lie, then the real question is, who possesses the keys to the system, and what happens when the watchdogs are simply no longer there to bark? Thank you so much for joining me for this explainer. I really hope this deep dive into the data has given you a powerful new perspective. Keep asking questions, and we'll see you next time.